In this video, I will show you the secret to outperform the market, specific formula that you can use right away to find stocks that will make you outperform the market in the long term. And I will do so by commenting on this beautiful tweet from Long Only. We will take Lam Research as an example and we'll go through the different steps, the different financial indicators, the fundamental analysis that is shown, revealed for Lam Research. And that is the reason why Lam Research has generated so much returns for their shareholders. So we'll talk about this, but it's only a 5-year CAGR here. So I have created this chart with a 5-year, a 10-year CAGR, and we can play around with the data. Okay, so Lam Research, in case this is a company that you don't know, I will explain what the company does. I will tell you how efficient they are, and full disclosure, I'm a shareholder of Lam Research, right? So, well, you see the stock chart. I'm heavily positive on this one, heavily generating a lot of cash flows, which is good news in the short term. I don't have to lie about this one, but I think this is a long-term buy and hold because this is such a beautiful compounder and it is very much in a very good area to outperform in the long term. Given what we are seeing right now in technology and AI in the world, I think this will continue to outperform the market. Okay, I think we can start. In case this is your first video from this channel, welcome. My name is Christophe Noor. I've been investing in the stock market for almost a decade now, and I have achieved a performance of 25% per year. And the goal is just to buy and hold for many years and do the analysis before you buy, so you can only buy the best performing companies. Okay, so let me start with this tweet from Long Only. By the way, you can subscribe to this tweet, you can follow him. A great analysis. Here is how Lam Research turned 13% growth, revenue growth, into 34% share price growth. So you are talking about margin expansion, cash conversion, buybacks, and multiple expansion. Don't worry, I will explain every line. So he is sharing a table with the CAGRs, so compound annual growth rate, for the past 5 years of the company. You see that over the past 5 years, the revenue has grown at 13% per year. Fair enough. Well, if you don't know what Lam Research is, this is one of the largest semiconductor wafer fabrication equipment manufacturers in the world. So you are talking about a chip company, very important in the process. You are talking about a company that is quite essential when it comes to chip components. You have a few companies that are similar. You can write this down. Applied Materials, the ticker symbol is MAAT. You have Tokyo Electron, pretty good. KLR Corp, the ticker symbol is KLAC. Anyway, you have a few players that are very much essential to this new environment, this new AI world that we will live in. And actually, you have a large moat for this company, a wide moat. And over the years, because of all the billions of dollars of investments, the moat, the barriers to entry are much more important now. And if you look at the financials of this company, you can see very strong margins, improving margins over time. Revenue is literally up and to the right. You have the cyclicality of being in the chip industry, semiconductor industry, fair enough, but it's up and to the right. Net income up and to the right. Free cash flow, look at this. Free cash flow up and to the right, despite the heavy capex that is needed. Well, Lam Research doesn't have much capex actually. And what do they do with the cash? They reward shareholders with buybacks. Okay, they have a small dividend yield of less than 1%, but we are talking about a company that is profitable, improving every year, growing every year in a specific industry where they thrive, and they like their shareholders. They reward shareholders through dividends and buybacks, and they don't have a lot of debt. They don't have a debt problem. They have $6 billion worth of cash, $5 billion worth of debt. What about the golden scenario you are looking at right now? So wonderful. Okay, By the way, if you want to become a better investor and improve your performance, I have a coaching program. It gives you the exact method I've used to generate 25% per year for almost a decade. More on that at the end of the video. On the tweet, you have a revenue growth rate for the past 5 years that is at 13% per year. Okay, gross profits, so you deduct the COGS, cost of goods sold, of 14%. So the company is getting a little bit efficient when it comes to their costs. The next line is operating profits, 17%. See how you just had an alpha of 4% just based on the costs. The difference between gross profits and operating profits, that's the SG&A, that's the salaries, that's the administrative costs, and the difference you see here between the revenue 13% and the EBIT, the operating profit of 17%, it shows efficiency. It shows better margins over time. And I can even show you what I mean because I can navigate through some tabs on Stock Unlock. This is a great website that I'm using for years now. I've been using this website for years on a daily basis. And you can look at the margins for this business. By the way, if you're not using Stock Unlock, you are literally missing out. This is one of the best websites you can have to invest in stocks. And you can use my discount code on my description, an affiliate link, so it gets like 10% cheaper for you. Okay, look at this. For the past year, the gross margins have improved. Look at this. This is for the past 5 years. Where are we? Let's see, 2020. Gross margins at the time were 46%. Now 48%. Okay, small improvement here. What about the SG&A margin? So the cost, the margins for the cost. In the past, 5 years ago, the SG&A cost represented 7%. Okay, now 5%, 2% change again. And the improvement in gross margin, the improvement in the SG&A efficiency creates this big margin improvement when it comes to EBIT margins, operating margins. So in 2020, it was 26. Now it's 30, 32. So you are talking about 6 points delta, I would say. You can create this gap. And you see for the past 10 years, this company, 10 years ago, they had an operating margin of 16% and now 32%. The company has gotten twice as efficient for the past 10 years. Twice as efficient for the past 10 years. You don't have a lot of companies that are doing this. Let me continue. Net income, 19%. The difference, that's the taxes and the interests. So, yeah, you have your margins for net income actually here improving. So, better tax rate, I would say. What about this line? Free cash flow. Net income, so profits, and free cash flow. What is this difference? The difference is the cash conversion, meaning what is the inflows of cash? How do you manage your inflows of cash? How do you manage your inventory? How do you manage your working capital? Do you receive money upfront, or do you receive money with a delay? Do you pay your suppliers upfront, or do you pay your suppliers with a delay? Do you have some advantages because of your scale? Apparently, Lam Research enjoys very nice advantages, and this is the reason why the net income is only growing by 19%, and the free cash flow 23%. So you see, now you have a 10% gap between revenue and free cash flow. Now we are speaking. The difference between free cash flow and free cash flow per share, the next line, is 4%. 4%, the difference is only the per share metric, per share data. This is what I said previously. On an annual basis, this company is repurchasing shares. Look at this. In 2021, they repurchased 2% of their shares, so buybacks. In 2022, 4% of their shares. 2023, 2 or 3%, 2 or 3%, 2 or 3%, again and again and again. They are repurchasing their own shares, investing in themselves. And this creates this gap between the free cash flow per share and the free cash flow. A 4% increase here. Now, what is left? Over the very long term, stock prices follow free cash flow per share. Sometimes you have the exact same number, meaning if your free cash flow per share is growing 27%, your stock price will grow by 27%. And sometimes it grows by more than this. The share price has been growing at 34% per year. This is the reason also why I'm outperforming the market, because I'm spotting these opportunities that can have an immense potential because the fundamentals are so good, and at the same time you have a re-rating. Okay, so if I look at the price to free cash flow for this company, you have a re-rating, meaning in the past, 5 years ago, 2020, you had the price to free cash flow of 17, 22. And can I show you, not even on a quarterly basis, but on a real life basis? Can I show you the price to free cash flow over time? You will like it, I think. Okay, let me erase everything here, and you can have the price to free cash flow. This is your evolution of price to free cash flow over time. You have wild fluctuations. In 2020, when we started, it was at what, 20, roughly 20. You go to 25. Well, now it's 35, 32, 35. So you have multiple expansion. By the way, guys, in 2022, you had a price to free cash flow of 14, 15. By the way, in 2024, you had a price to free cash flow of 20. You could have bought here. Okay. The 4 things that helped Lam Research achieve this kind of result, 30% per year, are margin expansion, so more efficiency, cash conversion, so how do you manage your cash inflows and cash outflows, buybacks to reward shareholders, and multiple expansion. So keep in mind, these are your metrics for the past 5 years. I want to show you the past 10 years. Okay, so now, let me show you since, let's say, end of September. Okay. You should have roughly the same. I don't know what is the starting point for the tweet, but let's say this is our starting point. The data will look a little bit similar. Yeah, pretty similar. Okay. If you look at the past 10 years, you will see that this is also true. Lam Research has been a beautiful investment for the past 10 years, and it can continue. For the past 10 years, the revenue CAGR, compound annual growth rate, was 13%. The gross profits, 14%. You get 1% more. The operating income, 20%. Now we are talking about strong efficiency for the past 10 years, okay? This company has gotten much more efficient. Free cash flow, 20%. So you can see, oh, where am I? I need the net income. I didn't improve net income. Net income. What about the net income? Let's see if you have a cash conversion that is helpful or not helpful for the past 10 years. Net income was 21%. Free cash flow was 20%. You see, for the past 10 years, you have a reverse momentum, I would say. In the past 5 years, free cash flow growth is higher than net income growth. But for the past 10 years, that's reversed. Anyway, we are talking about a 20% growth rate, and we will never complain about this. Net income and free cash flow are both growing at 20% per year. What about the free cash flow per share? Free cash flow per share, you have a line that is at 24%. Yeah, similarly, the momentum is the same. Free cash flow is 20%. Free cash flow per share, 24%. So over the very long term, the stock price should grow at 24% per year. The only difference is the price re-rating, the valuation change that you will get. And now, as the stock is on a run, you have a stock price that has grown for the past 10 years at 36% per year. If you find these golden opportunities, you increase your chances of outperforming the market by a lot. This is also the reason why I'm outperforming the market, even this year and for the past decade, because I spot these opportunities. I can list a couple of these companies with the same chart pattern, with the same capital allocation decisions that help stock prices. And if you fill your portfolio with these kind of opportunities, you will outperform, obviously. If I remove this big run-up, if I play around with the numbers and I remove this run-up and I say, okay, let's say we are at the beginning of 2025 and the CAGR for the stock price is not 34%, but it's 31%. Let's see for the free cash flow per share, 22% per year. Even if you take into account this, the re-rating is so huge for the past 10 years that it will obviously help the stock price. Because 10 years ago, the price to free cash flow was low. 10 years ago, the price to free cash flow was 13. So you go from a price to free cash flow of 13 to 35, obviously stock price will skyrocket. So you can play around with some numbers. You can take 2014 instead of 2015. You can play around with all the numbers you want. Actually, the valuation was reasonable here. I mean, let's put 14 for our example, and that's more reasonable, I would say. Since 2014, the free cash flow per share has gone up by 25% per year for the past 11 years, so that's huge. And the stock price has followed, plus 28% per year. This is the kind of companies you want in your portfolio if you want to outperform the market. So yeah, Lam Research is a perfect example how a reasonable company growing revenue at double digits, 12%, 13% per year, if they are becoming more efficient and allocate capital the good way for shareholders, it can create great results. If you like this content and you want to go deeper, I have a coaching program. In this program, you will learn the strategy I use to outperform the market. You will learn how to find winning opportunities. You will learn how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio with great companies. Additionally, inside the program, you will have access to an exclusive community of like-minded investors, and you will also have access to my personalized guidance to reach your investing goals. Click the first link in the description to get more information. You will get a short video that explains how everything works, completely for free. No need for your email address, just click the first link in the description and I'll see you on the other side.